What are the premium and discount zones? For high probability setups, we want price to be in the best areas as possible. To gain probability, in our trading we are using the Fibonacci tool to see if price is in premium or discount. We can increase the probability of profitable trades by buying in the discount zone and selling in the premium zone. Additionally, premium and discount zones can also be used to identify valid supply and demand zones for trading purposes. For example, in a bullish market, focusing on trading the demand zones located within the discount zone can enhance our trading strategy and minimize potential losses. How should the premium and discount areas be drawn on the chart? To identify premium and discount areas on the chart, the Fibonacci tool can be used by connecting the swing high and swing low of the price. The zone located below the 0.5 Fibonacci level is known as the discount zone, while the zone above the equilibrium line is known as the premium zone. It's important to note that these zones are only reliable if there is an impulsive movement that breaks the recent structure. To further improve our analysis using premium and discount zones, we can divide it into 3 equal parts and assign them different colors. To improve the chances of successful trades, we should aim to buy in the discount zone and sell in the premium zone. The red section on the chart indicates that the price is in a deep premium zone, which is a good opportunity to sell. On the other hand, the blue section represents a deep discount zone, where it is better to look for buy opportunities. It is not recommended to buy in the red or sell in the blue zone, as the price could easily reverse and take out traders' stops due to low liquidity during big moves. It is relatively safer to trade in the gray area, but the closer you get to the premium or discount zone, the riskier it becomes to do the opposite of the zone colors. To draw the premium and discount zones in a bearish scenario, the Fibonacci tool is pulled from the start of the impulsive movement to the end of it. The same concept applies in a bullish scenario. Now let's see a real chart example. We have the 4-hour euro-dollar chart on our screen. As you can see, price after mitigating this perfect demand zone was rejected and rose up sharply to the upside. Then it reached the supply zone where it showed a small rejection and flipped the zone to the upside, creating another perfect demand zone. Now, we should monitor price and wait for the price to reach the flip zone. Currently, as you can see, the price is within the flip zone, which aligns with the blue discount zone of the Fibonacci. Next, we will zoom in to a lower time frame to identify any market structure shift and also look for more entry confirmations. Here we have the 15-minute time frame chart. As you can see, price created these bearish structures, but it created a change of character by breaking out of this structure to the upside, flipping the supply zone to the upside and leaving behind a great inefficiency. This scenario is one of my favorite setups due to its high probability. If you look closely at the chart, you can easily detect these VSR patterns just before significant price movements to the upside. We've identified the entry confirmations we are looking for before placing a trade. However, to gather more confirmations, I will add the RSI indicator to the chart and look for possible bullish divergence signals. To identify a bullish divergence, we need to compare points A and B on both the price chart and the RSI chart. We can draw a line between these 2 points on the price chart and see that the price is making lower lows, while drawing a line between the corresponding A and B points on the RSI chart shows that RSI is making higher lows. This indicates a bullish divergence signal. In addition to the RSI divergence, we also have 2 VSR patterns, and price is in the blue discount zone. With these 3 different entry confirmations, we can take a long position. To do this, we should highlight the flip zone created by the wave that flipped the recent demand zone. This will be our point of interest, where we will place a buy order. Then we are going to set our stop loss a couple of pips below the lowest point of the zone and aim for this swing high as our take profit level. With these steps, we can take advantage of the entry confirmations and potentially make a profitable trade. Now that our buy order is in place, let's see how the market reacts. As we can see, our order has been activated and we have successfully entered the market. Now, as you can see, our take profit has been hit and the trade has been closed with a profit. After an in-depth discussion of the entry confirmation methods used in the smart money concept, it's time to apply this knowledge to real chart scenarios. By examining trading examples on the chart, we can gain a better understanding of how these methods work in practice. So let's delve deeper into the application of these concepts and analyze some real trading examples.